Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, January 19th, 5:09 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, cautious uptrend. Things were looking pretty nice about 2 days ago. Gapped up in the morning, which was a continuation and slightly higher highs of the rally that we had off the lows. And then starting Wednesday around 10:30 Eastern time, we've just been selling off ever since then, 2 days down. And it's really starting to get to a lot of people. Dan mentioned to me after the close that he's taking nonstop calls with people that are concerned about their accounts being read, the market being read. And the market will either wear you out or scare you out. And I think it's doing a little bit of both to some people. He's also taken the same amount of calls from people that are looking at their statements from their other advisor, and we're down 25, 30, 35% last year, and we're in process of moving over to Revere, and we hope we can uh, put our process in place and stick to our word and help those people out when they get over here. But no question about it, very tough market, the toughest uh, the toughest I've ever been involved with. I wasn't as involved in 2007, 2009 because I wasn't managing money then. I was still in IT. 2018 Q4 and COVID were a breeze compared to this because they were short term, harsh move down. They were more event driven than the slow grind that we've been seeing over the last year. But every day that we survive is another day closer to the end and a day closer to a bullish market. There were a lot of breadth indicators late last week that fired and indicated that the worst was behind us. The market didn't seem to care about those at all. Like I said, the last 2 days have been very tough to the downside after a consolidation on Tuesday. But we keep our risk parameters in place. We've lost less than the market each of the last 2 days, but that's cold comfort when you log in and you see your account red, and it wears people down. And some it just scares them and they just want to get out of the market until the coast is clear. The problem is the market never rings a bell at the bottom, nor does it ring a bell at the top. So um, we stick to our rules. We'll be under allocated when we're in a unhealthy market. We spent a couple days above the 200-day moving average last week. Then with those breadth readings that we got, things were looking a little bit bullish, but the indexes didn't hold it this week. We've reduced exposure by about half from what we came into the week, and individual stocks are still holding up better than the overall indexes. In fact, only uh, this week, only 3 of the 21 over 21 list have broken the 21-day moving average. I have a secondary list that has 85 stocks in it. Only 20 of those 85 have broken the 21. So there's a lot holding on. There's a lot that came back and to their 50-day or to their 21-day moving averages today. I'd say probably about a third of the total universe. So it's put up or shut up time. And what just happened today, I'm getting a little ahead of myself, but the support range that I talked about yesterday, even though these numbers are not pretty, that support range held. So that's a check mark in the bulls column, even though we broke the 21 in the 50 day. So SPX 21 and 50 MAs fail, but the support range holds. This is one close below these. Maybe it's one day, maybe it's worse. If we we'll see what cards come out of the deck. I mean, quite obviously, like I said, the market's tough. Um, a lot of fake outs, a lot of shakeouts, but breakouts started working this year. I went through a video and I had about 50 of them, and about 40 of those 50 are still holding up fine. But a lot of things got extended and are just pulling back now. We're keeping our eyes on those leaders, but on the other hand, some of those that ran fast out of the gate are reversing hard I'm talking to you solars. We'll review the solar stocks today. But net, we weigh the evidence every day, take our appropriate action that we feel is appropriate, and live to fight another day, because you can't be in the battle if you've lost all your ammunition. So let's check over here on the trend gauge leaders. Uptrend, but with the yellow arrow, some of them fading, but not many. Short term yellow arrow a little further over to neutral today with the close below the 21, but again, one close below the 21. We need at least two for a trend. Same thing with the 50-day moving average relative to the S&P 500. Uptrend, but neutral on the arrow, the sub arrow. Long term, neutral relative to the 200-day moving average. As always, we'll take a look at all five of these major indexes, a couple of other key indexes, and then a focus list. And let's just get right into it. So first of all, what do we do here at Revere Active Management? Our number one job is to protect the downside. Uh, how you protect the downside, the definition varies according to a lot of people. To us, protecting the downside means we participate in the market if things are trending above the three time frames that we track. If they start to break below the intermediate term and the small term, we take exposure off. If we break below the black line, that's the 200-day moving average, we get to a very defensive posture in the market, and that is because of this chart here, where it's the last 13 bear markets. In October, we bottomed out 27.5% in 2022. We bounced a bit off of there. So it didn't make the severe bear market calculation, which we consider 30% or more. It still might. These 2000 to 2002 and 2007 to 2009 weren't all within a calendar year. Some of them went down, then bounced, then went further down. This wasn't always straight down 50%. You have to weigh the evidence. There's times to be partially long. There's times to be not long at all. There's times to be fully long. But under the 200-day moving average, this is the numbers just support. This is where the bear market occurs. And this doesn't mean we're going to be completely unscathed once we get under there, because there's other short-term indicators that lead us to get back into the market. Every one of those short-term indicators to get back in has unfortunately failed with a move into the 200-day moving average 4 times now since August. Also had one in November, December, and now most recently this week. This was by far the healthiest. I've detailed this in videos. This was the healthiest of the advances because of the breadth of the advance. How many, in other words, how many stocks in the total universe were participating? The fact that we had a 3+ week base that it came off of, instead of chopping all over the place like we did here in September, October, and back in June and July, which launched the prior two attempted rallies. And I was very optimistic. All of our stats supported it, but the market, frankly, as of 10:30 a.m. Eastern time on Wednesday, completely disagreed with that assessment. Here's the gap up, and then just the immediate selling came out of nowhere. There were no bids. A little bit of a bounce, sold off into the close. It continued with a gap down today. Tried to go sideways for a little while and rally, and then sold off into the close again. So that's the bad news. The good news on the S&P 500 is that we did hold. I did a video last week saying that after this follow-through day on the 6th, on the 9th and the 10th, we started to pull back, and we needed to hold this 3878-ish area. And we did here. We did overnight. We started to rally again. Now the last 2 days we came down again, and we held it overnight and intraday again. So very key, this 3877 at support. We need to bounce off it. We did today, even though we were down. The 60-minute stochastic is extremely oversold. You can reference here any other time it gets oversold. Now, sometimes it stays oversold for days at a time. It is a 60-minute. But when you bounce up off of there, you get at least a relief rally, and then you see where it stands. relative to that. But for now, the next area that we're looking down, we want to make sure we hold this 38.77. We closed at 38.99. If we break that, then we get into this very strong support area where we based for 3 weeks, and we were unable to break down below 3,800 and hold it. We had one close below it. We got back above it immediately. Every test of it, we started making higher lows before we had this follow through day on the 6th. A little bit of a pullback, another thrust forward with the breadth in the market that I was talking about, but the last 2 days just gave it up. We have expectations every day coming into the market. This was an expectation breaker, no question about it. So back on the daily chart, uh, below the 50 and the 21-day moving average for the first close, the 8 has rolled over. So right now it's another failure at the 200-day moving average, the fourth one. A lot of people were arguing that this one was going to stick because seriously, everybody that you talk to about the market was talking about this downtrend line in the 200-day moving average. And sometimes when things are so obvious, they don't work. Sometimes they're so obvious, they do work because they worked here, 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 and now this fourth time we're running into resistance and we should fail. And that's what happened. But we take it day by day. Like I said, negative that the stochastic is rolling over. It's possible to get a chop after you roll over, and we hold this area here. But for now, several of our stops got hit. Recent new entries not working. We obey our stops, took us out of the market. And one of these times we'll get a rally that will put a big Band-Aid over all these paper cuts. And will be as good as new, and boy, do I look forward to that day. So if you're interested in this approach or you want to talk more about it, email me, don@revereasset.com, or my partner, Dan Stewart, dan@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. So there's the close below, but we did hold the range. Let's go to the NASDAQ 100, which relative to the 21-day moving average is holding up better than the S&P 500. It broke the 50, but is holding the 21. You can see the relative strength on the NASDAQ 100 over the last 2 weeks. QQEW was once again down more than the NASDAQ 100 today. We had Apple green, Google green, and after hours, we've got Netflix green on earnings. So more ammunition for this holding the 21. We did pierce it intraday, and when we broke the 50-day, I put a hedge on. So we're basically neutral versus the NASDAQ. The next move up, I'll get rid of the hedge. The next move down, we'll hold the hedge and get rid of the long. But for now, we're neutral relative to the NASDAQ and long versus the S&P, as long as we hold that support range that I talked about. Dow Jones Industrial Average continues to be weak. Harsh break below, and after being the leading index for weeks, has now been a lagging index for the last 3 weeks. And you can see on the 60-minute chart how we're well back into this band of support that broke. That was at the 33.5 level. If you're comparing them. So let's take another look at this. Let's look at the NASDAQ 100. You can see how much higher up it is relative to its band at 270. This actually has two levels, 270 and 275, and 275 did hold today. So it's got one level there and one level there. And then, of course, the level that I talked about with the S&P 500 close, but still not down into the range the way the Dow is. And let's take a look at mid caps and small caps. I think these 60-minute charts with no moving averages on it give you a cleaner look sometimes. 450 is the key area here. For mid caps, we bounced at the 21-day moving average for mid caps today. In fact, we didn't even quite get to it, but we did break below the 80 MA. Same thing with the stochastic rolling over. While the stochastic is rolling over and we're below the 8, we're really not going to be putting many longs on unless we get a washout and a reversal. Small caps here held the 21 and the 50, sitting basically right on the 200. So a big confluence of all the moving averages there. Here's the 60-minute chart. You can see the key level for this is about 177. and we're quite a bit above there by, well, 182 to 177, so 2% or so. Let's go to very quickly the equal weight uh, QQEW. There's also a QQQE, so there's really two of them. They look similar, sitting on the 50 and the 21 there. RSP equal weighted, S&P down worse than the big cap heavy weighted today. Still above the 200 day, sitting on the 21 and the 50 day moving averages, but it's also rolled over. Those were the equal cap indexes. How did the VIX do today? You'd think with us being down the second day in a row, there'd be some fear, but there's not. Well off the lows or well off the highs on the VIX, we reclaimed the 21 and we're still sitting back in this 20 area. So there hasn't been a volatility event. The dollar was down, then flat, then down again today. Let's look at a 5-minute chart so you can see a gap down. The market was pulling back while it was rallying, and then the market rallied a bit while it was pulling back, but it closed near the lows on the day. But an inside day relative to yesterday, still trending below the 21-day moving average. There's a lot going on with the yen and interest rates over in Japan that is impacting the dollar more than it normally would. Let's take a look at the bond indexes. We'll start with corporate bonds, LQD. Down slightly on the day, still trending. The trend is up on them. BND, the broad bond index. This includes treasuries, corporates. The trend up on that, holding the 200-day moving average. Junk bonds, JNK. You can also use HYG. Pulled back 0.67, sitting on the 200-day moving average. The long-term 30-year TLT still under the 200-day moving average inside day today. So that with the price being down, that means the yields are going to be up. Let's take a look at the 10-year here. Yields up a bit, but again, an inside day after the big move down yesterday, and TYX is the 30-year up today, but another inside day. So decision time for rates with it being inside, which way is the next move going to be? We don't venture guesses on stuff like that. Um, because you can't predict the markets. You can interpret them and get on the right side of them, but predicting ultra short term what's going to happen is a fool's errand. Here's gold making a higher high with the weak dollar. Good stuff there. How about silver, which has been lagging gold? Up, bounced off the 21-day moving average today, putting in a little handle in this long cup. And gold and silver stocks had a nice comeback today after a rough day yesterday, recouping most of it down 2.6%. 3 tight days here as it consolidates. And this is best case scenario. What you're seeing with a lot of sectors and stocks is when you had this 6, 7, 8 days up, some of them have just pulled back and consolidated nicely. And some of them have completely given it up, like TAN has given up half of the move. And if you look at the individual stocks, and when we get to the tail of the tape, really harsh day for the solars today. Bitcoin, let's go to the 60-minute chart on Bitcoin, and it's consolidating for the last 3 days. A little bit of volatility yesterday along with the market, but Bitcoin outperforming the market now. So let's get now to the tail of the tape. The stochastics are not painting the best picture, but the McClellan Summation Index, this moves slowly, but when it moves, it's a true tailwind. Let's take a look quickly at this. I'm going to bring this into the screen. 2 things I want to talk about here. First of all, let's talk about the AAII bullish sentiment. So this was that real low 2 weeks ago where there were so few bulls that there was a lot of talk that that had to put a bottom in the market. And we did. We had a follow through day the next day or 2 days later, gained 6% on bulls the next week, gained another 7% this week. The bears went from 42 to 40 to 31, still hanging around 36, 37 for the bears, but big uptick in bulls over the last 2 days. This kind of lags. Uh, People have several days to vote throughout the week. If you voted on Monday or Tuesday, you probably voted completely different than if you would have voted late on Wednesday. But you can see bears moving from the bear camp to the bull camp, very similar to what you saw at Revere here. As we followed what the market was telling us, yeah, there's a chance you could get shaken out, and we did. But the reclaim of the 200-day and the good breadth indicators were enough for us to get more involved up to 0.7 of the S&P. We're back down to 0.44 now. Here's the McClellan Summation Index on the NASDAQ. You can see it's still in overbought. This moves slowly, but when it does roll over, it's normally a good trend to stick with. You can see this is still pointing straight up. It hasn't updated for the day yet today, but it is something that I keep a close eye on for changes. So the stochastics, not what we'd want them to be on the indexes and the G6. Fear and greed down to a 53. That's neutral. Um, Still trying to determine the bull bear case. It's mixed, absolutely. Bulls holding on to that support range. Bears trying to break back through it. A little bit of news: initial jobless claims were below expectations. Day count went from 1 day down to 2 days down. We're now 2 days below the ADMA, 1 day below the 21-day on the S&P. Neutral expectations coming into today with us breaking below the 200, but still above the 21 and the 50, but now breaking below. This was a more of a negative day, but as long as we hold that range, that support range, that's really what I'm keying on. Broke below this 21-day support level, holding the support range at the 21 on the NASDAQ 100. So again, the NASDAQ 100 holding up slightly better than the S&P 500. Action with the gap down, tight 1% range chop all day. So at least after the gap down, not really showing any penchant for going further down. As you can see on the 5-minute chart of the S&P 500, how tight today's range was. High of 39.23, low of 38.85, 23 and 85, at 23 and 15, 38, and we're at 38, so about 1%. Very tight range. The average right now is about 1.6 on the ATR for the S&P. What was strong today? Gold, and silver stocks, KWEB, and emerging markets. Started down but ended stronger was XLE and XOP and banks. Bond prices down, which meant yields up. Dollar down, solar's down, builders down, industrials down, retail down. Here's the focus list. We'll go over those charts momentarily. In-house, Chewy, 2% position, sold for a loss of, I think, around 8% by the time we got out of it. Definitely not one of my better trades. I explained yesterday why we got in it with this, and very often when you see a gap down on a downgrade, if it gets bought up right away, it's extremely bullish. We fell for it, we bought it, it sold off. With the market yesterday, gap down this morning, no buyers anywhere to be found, broke below the 21, stop triggered. We got out, still below the 0.20 threshold versus total assets under management that we use for every single position. So 5 of these means you lose 1% on your overall bottom line on your portfolio. Let's see. So Chewy SSO we trimmed when we broke the 21. So we took off some of our long. We trimmed half of JP Morgan. This is another one. This big positive reversal to the upside on all the banks on Friday. Let me look at a 15-minute chart here. Here's what I'm talking about. So all the banks gapped down and they were bought big time. When we broke above here, we bought it. Yes, it's higher risk because it's a breakout. And then Monday, terrible Goldman Sachs earnings. We gapped down but finished near the top of the range, pretty good. Gap down, tried to recover it on Wednesday, sold off with the rest of the market. Gap down today. sitting on the 50-day moving average below the 21. We sold half of our position on this for about a 6%, 5 or 6% loss. And then QID, I mentioned, to offset our QLD. We're going to see who the winner is on the NASDAQ over the next couple of days. Bottom line, another rough day. Moving averages fail, meaning the 21 and the 50 on the S&P, but the support range holds. We need to key on that range being held before we get back into that 3,800 area. 3,800 to 3,880. Really, it's 3,780 to 3,880, another 100 point range area. But if that gives way, then we're looking at some bad stuff for the market, plain and simple. This is the tight range that I'm talking about. We do not want to lose that because there's very little support below that, all the way down to the prior shakeout at 3,500. So that is the tail of the tape. Let's go to the focus list now, and what we're still holding in-house. Half position in JPM, I sold that. Still holding 1% in AEHR, very volatile. Tried to break out yesterday, reversed, bounced at the ADMA the way we would want it to. XBI Biotech, 3% size on this. Pulled back. Let's look at the similar 60-minute chart on this, and you can see the range breakout and pull back right to the top of that range today and bounced. Today's lows are what we want to see hold in the diversified biotech index. And let's take a look at some stocks that had a good day today. Optimism into this report for a change. GEHC, GE Healthcare, undercut. I remember me mentioning that I wanted to see if it would hold the 8 EMA. Held it yesterday, undercut, and then a nice bounce on reclaiming it today. Still not ready because of the overall state of the market to get into this, but I do like the way it's acting. Mercado Libre, uh, setting up very nicely. This is a former big leader, had a nice move off the bottom on massive volume last week. And these 3 days of a pullback are nothing really compared to what the index is doing. So yeah, breakouts are still risky. Remember, I had a list of about 50, 60 of them that held. They're absolutely risky. We'll have to see what the market's doing if this would attempt to make a breakout again. If the market's not reclaiming moving averages, then it's not a buy, uh, plain and simple. But you can see the relative strength over the last 2 weeks on it. So Melly, we want to discuss that. Another one I don't know that we've talked about, Rambus, very nice acting semiconductor. This is a very familiar pattern going into the follow-through days. This meltdown into the 21 and the 50, and then a strong move off of that. A lot of the strong moves, though, have given it back the last 3 days, but you can see Rambus with an up day yesterday and an inside day today. That's good behavior, leadership quality behavior. On the other hand, former leader SMCI pre-announced and raised their guidance. Market didn't like it. I guess it was expecting it to be higher. Gap down 10% today. This is a broken. It was really kind of. I mean, look how this gapped up. Some of these stocks are just bipolar. Gapped up all the way up to 93 on the 9th. Big reversal. Tried to reclaim it now from 93 down to 70 in 7 trading sessions. That's why we always keep a look at an eye on the ATR of what we're getting into, because sometimes it's just not worth it, especially in a questionable market. Now let's take a look at the solars. FSLR regained leadership for a while, this move off the lows, but it's given back half of that, still above the 21. But in 3 days, you go from leader to guaranteed a lot of people getting stopped from 185 down to 165 in 3 days. Those are tough numbers. End phase never really reasserted itself. This has gone from leader to absolute laggard. Sedge, SEDG, trying to gain the leaders, but has really given up all of its move, breaking below the 50 and the 21, sitting on the 200, down 10.3% on the day on heavy volume. Let's see what else we got. Array, this is a volatile one that again, 8 to 10% ATR, I just stay away. Uh, given from down from 25 to 23 in 2 days, still holding the moving averages though. SHLS, kind of a new play, uh, was a leader going back a few months, still forming its base. Four strong up days here, two nice days of contraction, but down 5.7% today. However, still holding the 50 and the 21. I'm seeing a lot of stocks coming into the 50 and the 21. And like I said, it's time for them to put up or shut up, either bounce, and the market's going to have to go higher. They won't all bounce if the market doesn't participate. There are some leading stocks that are, excuse me, absolutely holding up, but they can't go higher if the market doesn't participate. You got to have the M in the market, as William O'Neill taught us all those years ago. And that's going to wrap it. As always, feedback is appreciated. Don at revereasset.com. If you click dislike on the YouTube video, give me a comment and tell me why. Otherwise, how do you expect to get any improvement or what you want? Or if you disagree, fine, let's have a debate about it. But clicking dislike without providing um, feedback is just being a coward. So uh, talk to us if there's something you want to discuss. So Don at RevereAsset.com, or my partner, Dan Stewart, Dan at RevereAsset.com, the phone 855-REAL-WEALTH. That's 855-732-5932. Remember, folks, it's not how much you make in the market, it's how much of that you can keep. We've been suffering quite a few paper cuts over the last quarter. As Ed Sakota, legendary trend follower, says in his Whipsaw song, one good trend pays for them all. And that's what we're looking forward to, and that day can't get here soon enough. So anyway, wrapping up. Thursday, January 19th, this is Don Vandenbord telling it like it is. Just the facts here at Revere. We appreciate your viewership, and have a great day. Thanks.